Hold that thought, Gaurav. We're also bringing up this conversation to Dennis Kovalchik, who's the Chief Investment Strategist at CFC Seymour. He's joining us from our Hong Kong studios as well. Dennis, good morning to you. Thank you so much for joining me. We're basically discussing the health of the Indian economy right now. From where you're sitting, from an FII perspective, how have you read the interest rate hikes that the Reserve Bank has done, and how are equity markets positioned from a valuation basis for you?
I believe that the central bank did what they had to do given the surprisingly sharp increase in inflation and the fact that it exceeds the central bank's target by more than 100% by now. So it appears that the two increases in interest rates in June are the start of a cycle that should continue for the next several months. And in the longer run, it's a positive thing that the central bank is tackling inflation, but in the shorter term, it is unfortunately negative for the equity market. So I don't think that we should be in for any rebound anytime soon.
Right, you said the beginning of further hardening. How much of a further hardening do you foresee, and how do you see it pan out over the year?
I think that there will be around 100 basis points more in the second half of the year because real interest rates continue to be negative, and you cannot fight inflation when these rates are below zero. So the central bank unfortunately needs to move further up in terms of the interest rates. I think that they will try to front load the increases so that they can get the maximum impact from tighter monetary policy as soon as possible. So I would expect that the third quarter will see at least two more hikes, maybe by 50 basis points each. This would definitely help limit inflation expectations, which is what the central bank is concerned the most. And then further down the line, especially when we enter into 2009, the base effects will push inflation lower, so the central bank will no longer have to be that aggressive.
Gaurav, your take on that, 100 basis point more increase in rates, what does it really mean for growth, and do you also foresee that?
I think I'll be a little more kind of, I think about 50 to 75 basis points is what I would think, because you have to see that it'll be combined with CRR increases as well. And a repo rate hike and a CRR hike put together is a very potent tool. I think the central bank has been tightening for the last 4 years. But what we've seen is we've seen different instruments being used at different points in time, depending on the macroeconomic situation. But this is, I think, the first time the central bank has gone ahead and used both tools, and in a very significant manner, to actually temper expectations of higher inflation. So I would think that about 50 to 75 basis points repo rate hike plus a CRR hike of another 50 basis points should do for the time being, because you have also seen some fiscal measures being taken to curb inflation, and the central bank has been on a monetary tightening spree for some time. While I agree that real interest rates policy rates have turned negative, but market rates are running ahead of the policy rates. So in some sense, markets have kind of factored the fact that inflation is high and the rates will move in line with that. So I would be a little more let's say a little less pessimistic on the monetary tightening at this point in time. But if inflation remains consistently in double digits, then obviously you would require perhaps stronger monetary policy tightening.
Sure. Darius, what's your own sense on GDP growth for a market like India at this point of time? Where are you? The finance minister has spoken about 8.5%. And how are you watching some of the internals in India right now, such as the rupee and the bond yield, the way they're moving?
As far as growth is concerned, I think that the 8.5% target seems fairly optimistic right now, given that tight monetary policy will have a negative impact on domestic demand, and that the external sector will continue to subtract from overall GDP growth. So closer to 8%, I would say. As far as the currency and bond yields go, we have had an appreciation of the rupee recently to 3-week highs following the unexpected hike in the interest rate, and bond yields continue to zoom up. Over 9% for the 2-year is substantially above the level we saw in the first quarter, and this is one of the factors that is helping the rupee recover. I expect that the bond yields will have to move higher as the central bank tightens policy in the second half of the year, especially the 2-year yield, definitely towards 10%, and this will help the rupee recover against the dollar even further, ending the year at 41.5.
Right.